Let's first of all talk about these rescued banks. I know you're not covering them right now because you have concerns about the level of disclosure and all that, but they've obviously outperformed. So there is a story there. What are your thoughts on where we are, and why is it still not a safe bet to go into them right now, in your view?
In my view, I feel there are still challenges around valuations. I think right now, because we still aren't sure of how much the asset management company will buy up the bad assets, and because of that, you really don't know how much the company would get in terms of injection of capital and liquidity back into its books. And because of that, you really won't, it's still quite a challenge valuing the banks. And so in our own view, we still think it's still very risky. We feel because you can't value them, you really don't know how much you'd get at the end of the day, especially when AMCON invests in the banks, and also when a new institution buys up the bank. You don't know how much you'd have left in terms of shareholding. So you don't know if you'd have 10% or if you have 5% or 50%. So it's still not clear in my view at this time.
I think the sense is that in whatever scenario, the current shareholders are likely to lose out. Probably get maybe, I'm speculating here, 5-10% of the entity that emerges. But anyway, let's look at least the companies that seem to have outperformed to some extent with regards to their performance and the Q3 results. I pick Access Bank and Sky Bank as being one of the few that analysts are saying have beaten their estimates. What are your thoughts on the results we saw from those two companies?
Yes, I actually agree with you. Access and Sky Bank met our expectation in terms of top line, and I would say for the bottom line, it actually beat our expectation. Q3 results for Sky Bank was slightly ahead of our expectation, and because of that, we feel that the bank will more or less meet our full year expectation for the year. And I think what we still have cause for concern right now is the cost. We feel cost to income ratio for the bank is still
Access
quite for
Access or Sky?
For Sky right now, it's still slightly higher than where we feel the bank should be. We feel 65% at this point in time is still a comfortable level for them, but it's still in the 70s, and trying to keep that low we feel that should be more or less a concern, the focus for the bank right now.
The issue of cost to income ratios being high is obviously a topical one, because we've seen that pretty much across the board. First Bank, UBA, all the other banks which we've seen are showing fairly high cost to income ratios, about 70 or probably even more than that. Where can the banks really make the gains? One option obviously is to see how they can downsize on the staff cost. But what are the realistic moves that you think that banks can make now in bringing costs down?
I think right now, to be fair on the banks, they've really been quite aggressive in pulling down their costs, because if you compare costs to inflation, they've actually reduced compared to where inflation is sitting right now. And I think where the banks should really be focused on is trying to grow their top line. And right now, most banks aren't lending. If you look at all the results we've seen improvement in a few. We've seen improvements in the likes of First Bank. But I think Fidelity Bank loan growth has been stagnant. Sky Bank as well, we haven't seen such a strong loan growth, and also in Access as well. We haven't seen, I think overall, for what we've seen so far, we really haven't seen strong loan growth for most of the banks. UBA, that has a high cost-to-income ratio as well. There was actually a decline in loans and advances when you compare half year to the 9-month results. So I think where the banks should focus more really is on growing the top line. And I think right now there are still very few outlets really to grow risk assets. And so I think that's where we'll still have challenges at this time until banks can really start lending. That's when we'll see loan growth, cost-to-income ratios coming to decent levels and maybe sitting at 50%.
I mean, you mentioned Fidelity Bank, and to me, that's one bank that has been under the radar, really. When you look at its valuation right now, it's trading at some time half book ratio, half its book value, and you wonder, is this because this company is distressed, or is it just floating under the radar in your view?
I would say to a large extent it's floating under the radar, because if you look at the investor profile of Fidelity Bank, they are still largely local investors. There are few foreign investors that have invested in such a name, and so, and you know, because through the whole financial crisis, the whole stock market crisis, lots of the retail investors were badly burnt. And so what the situation we see in the insurance sector, where most of them are trading at half time their book value, I think that's what we're also seeing in Fidelity Bank as well. But if you look at the performance, at least for over the 9 months, we've actually been seeing improvement. There've actually been improvement in performance. PBT has been growing quarter on quarter. PAT as well, we've seen close to about 50% growth from half year to where it's sitting right now. So I think in terms of performance, it's been improving, even though 9 months result was still slightly below expectation. But
okay, my time is up, but very quickly, would you buy Fidelity Bank?
Right now, Fidelity is still a buy stock, and it actually presents an upside potential of about 71%.
All right.